Welcome to Synergy's 2022 Settlement Planning Summit. We've got an incredible lineup of speakers who are experts in the field who will be talking about issues that range from the tax implications of a settlement to use of qualified settlement funds, government benefit preservation and trusts, and also ethical and malpractice risks related to settling personal injury claims when you have a catastrophically injured client or someone who is disabled. My name's Jason Lazarus. I'm the Chief Executive Officer and founder of Synergy Settlement Services. And I've been working for the last 23 years with trial lawyers and injury victims, dealing with the case after the case, all the complex issues that can arise when you're settling a claim for someone that's significantly injured or is completely disabled for the rest of their life. The planning issues are the issues that I typically consult on and tackle with personal injury lawyers and the injury victim. My presentation is going to focus on just an introduction to settlement planning issues, which will start off with a discussion about the ethical issues that can arise related to advisement of injury victims at settlement, some malpractice risks, and also a discussion about some of the basics with settlement planning. So as I said, I'm going to start out talking a little bit about this obligation to advise, because I think it's important to go through the issues and understand for you as a trial lawyer what to be concerned about in terms of those obligations. So the obligation to advise an injury victim really stems from the legal issues that are created potentially by a personal injury settlement, and that can implicate a variety of different legal concepts and statutes. For example, if someone is disabled and receiving government assistance, then you need to be familiar with 42 USC 1396 PD4, which authorizes monies to be put into a special needs trust so that client can remain eligible for Medicaid. Similarly, having an understanding of the Medicare Secondary Payer Act and its implications, making sure that you understand the different options that are available under the tax code to injury victims when they settle a personal injury claim so that they understand all of those issues, because you as a trial lawyer do have an obligation to advise the client about those issues, which includes the financial piece of it, whether they enter into a structured settlement or not, because that's not an opportunity that they have to exercise an option available under the law. So you have to make sure that you're advising that client about those issues. And if you don't, then you need to have competent experts who can explain those issues to the client. And if you take a look at the ABA model rules, this idea of informed consent is an important one, that you've got to communicate adequately to explain legal issues to your client and make sure that they're aware of the alternatives. Similarly, the 2.1 allows lawyers to refer to external people who can advise clients to make sure that they have all the information necessary. And I think if you read through these two statements at the bottom of this slide, making sure that a client is informed about the options of structured settlements, trusts, and the effect of a settlement on a client's public benefits, a very important area of concern. Making sure that ultimately the clients understand tax implications, which is something that's going to be discussed today. And the failure to do so, there is precedent for liability. This Texas case, while it's quite old, has been discussed a lot over the years because it stands for this proposition of if you fail to advise a client about special needs trusts and the opportunity to enter into a structured settlement, there's potentially liability and damages that flow from that. So in this particular instance, the lawyers did not set up a special needs trust, did not advise the client about the loss of benefits, did not advise about the option to structure the settlement, and ultimately got sued for legal malpractice subsequent to the medical malpractice settlement. And the legal malpractice claims were settled for some significant sums, 1.6 million against the plaintiff attorney. And interestingly, over 2.5 million was paid by the guardian ad litem who approved everything. And it's just very hard if you're not advising the client to defend against allegations of malpractice. So you've got to make sure ultimately the client is advised. So this is just my opinion, but at settlement, really you have to make sure that either an expert advises the client about the laws that are going to impact that settlement, or you have to be able to do it. because if you fail to do it, there is no way that the client can make an informed decision, and then no opportunity to exercise options available under the law, which consequently can have damages flowing from that. I think, if you read together the ABA rules and things I've outlined plus Grillo, I think that message is really that you've got to employ experts to consult with your client about taxation, trust, structured settlements prior to settlements. The client understands it all. And if you don't do it as their lawyer, there's no one else that's going to, because you've got that obligation to explain legal issues. And really, even small settlements could trigger the need for these consultations, because if someone's a Medicaid or SSI recipient, as little as $2,000 could cause ineligibility for their government assistance programs. So the easiest way to remember the obligations is the acronym CAD, which is consult with competent experts, consult with your client, advise your client, and then make sure you document your file what was done and why, because that's an important part of ultimately making sure that your firm is protected when something bad happens to that client and they come back and say, why didn't you tell me? And you can show them, well, yes, I did. And we brought in experts who advised you about these issues, and you made this choice willingly. So I wanted to talk a little bit about disability planning because this is going to be covered later, but it falls within the rubric of just this introduction. Because your warning bell should go off with certain clients. So if you've got a client that's permanently disabled or has catastrophic injuries, those cases are ones where there's a higher degree of potential for a malpractice claim based on the failure to advise and failure to address some of these issues. So if you've got someone that's on needs-based government assistance, and this is going to be fleshed out in some of the later presentations, if they're on Medicaid and SSI, that's a case where you definitely need to do some settlement planning and consulting work with experts. If they're on Medicare, then whether a Medicare set aside should be done in evaluating potential threats to future eligibility. We've got some regulations on the horizon, apparently, for Medicare set asides and liability cases. So doing nothing, sticking your head in the sand presents some real major risks. And then making sure that in cases that involve minors or incompetence, that settlement planning is explored, because trusts and structured settlements are common ways of protecting a minor or an incompetent permanently. And so, what you have to think about are, does the case involve a settlement for someone that's on government assistance that's needs-based, or Medicare, or they're dual eligibles? Because those cases are the ones that really are ones where there's a significant malpractice risk. And the last part of the presentation, I wanted to give you a little bit of an overview about settlement planning basics. And the cornerstone of most settlement plans are structured settlements, but there are multiple options when an injured victim settles the case. They could just simply take a lump sum and manage it on their own. They could do a structured settlement or other annuity products. They could do a trust, or what happens most frequently is a combination of all those things. In 2016, I was involved in a pretty serious accident. And what I did was I took a portion of my settlement in cash, portion of it in a structured settlement, and then a portion of it in a medical trust, so that I had monies to pay for my future medical treatment from my injuries. And that's a very typical plan that's put into place for injury victims. But if a structured settlement is part of the mix, what you have to realize as a trial lawyer is that there are complicated issues related to structured settlements, and that's why you really should always have an expert planner working with you. Some of the issues are being aware of rated ages, which are reduced life expectancy that's used for pricing of structured settlements, and annuity rates, because the combination of those two is how you maximize return for an injury victim. Making sure that default risk is reduced by spreading premium amongst multiple insurance carriers for structured settlements, understanding the life company ratings of the different companies, making sure there's sufficient liquidity at death with a commutation provision, and then making sure that you don't trigger constructive receipt, which is a tax doctrine. So there are some cases that are really ideal for using structured settlements and overall settlement planning. Those are cases where you've got a trust or a special needs trust that's going to be done as part of the settlement, because it is more tax efficient to fund that trust over time with a structured settlement, since the structured settlement's income tax free, and it lowers the overall expense of administering that trust because the fees are typically based on the assets held in the trust. Also, if you've got a Medicare set aside, there is a much lower cost of funding an MSA due to rated ages and the cost differential of paying in over time. And also, there's a benefit because instead of having to totally exhaust like you do a lump sum Medicare set aside, you actually have temporary exhaustion each year, triggering Medicare to pay each year. And a structured settlement can minimize the cost of doing professional administration. If you've got a life care plan and catastrophic damages that need to be funded, structured settlement's really a perfect candidate for that. As I said, minors or incompetence. And when you have a case where there's very distinct known quantifiable damages, for example, prosthetic replacements or needing to replace a handicap equipped vehicle, those are things that are really great for funding structured settlements. And with that, I'll turn it over to our next presenter. Our next presenter is Jeremy Babner. He's a nationally recognized tax attorney who focuses his practice on lawsuit awards, settlements, and complex structures. He served as special tax counsel at the law firm Lane Powell and chairs the legal committee of the Society of Settlement Planners. He's the founder of Structured Consulting, which offers business advice to a wide range of companies, including those serving plaintiffs, general investors, and retail customers. Jeremy previously served full-time in Lane Powell's tax group and later as vice president to the firm Client Multi-Stream Capital, a financial company selling structured settlement income stream investments. He previously served as fellow in the U.S. Treasury Tax Department tax policy, focusing on partnership tax issues, including non-compensatory partnership options and debt equity exchanges. With that, I'll turn it over to Jeremy for today's presentation.
Hi all, my name is Jeremy Babner. I'm a tax lawyer at Lane Powell. I also have a consulting firm, Structured Consulting. I regularly work with plaintiff firms across the country, also banks and trust companies who regularly work with plaintiff firms on different aspects of settlement. I'll share my screen here. I know we have about 20 minutes, so I'll set my timer. Just a quick about me and my background. I actually, during law school, I started in the Department of Justice in their personal injury section. I ended up becoming a tax lawyer and working in the Office of Tax Policy at Treasury, worked quite a bit with the IRS and in the branches that deal with the taxation of settlement proceeds. I now serve on the legal committees with the Society of Settlement Planners, the American Association of Settlement Consultants, and the National Structured Settlement Trade Association. I mention those because they are good sources of information. I'm also on faculty with the Settlement Planning Education Center. So what we'll get to today, since we only have about 20 minutes, I'm going to walk through kind of the key things as a plaintiff lawyer that I think you should really be aware of in thinking about how you can be mindful and helping clients to reduce their tax liability. The first thing really to know and kind of keep track of, and this is true of structured settlements as well and investing, and that is that once you sign that settlement agreement, it's really too late to do a lot of the basic kind of tax strategies that you have the power to help plaintiffs with, whether you're going to be executing them, whether you're going to be working with the folks at Synergy on executing them, or if you're going to bring in tax counsel or an accounting firm. The key reason is because settlement language has a real impact on the actual tax treatment. And so we're going to focus a little bit today on impact of settlement language. Then we're going to do a very quick hits on tax treatment of different claims and damages. The overriding rule is that the tax treatment of settlement proceeds is very much based on the reason why the defendant is making the payment. So the defendant might be paying for 5 different reasons, and identifying what those are, allocating the right amounts is key in reducing the plaintiff's tax liability, because it gives you the opportunity to identify and allocate as much as you can to the claims and damages that if received by the plaintiff, will be tax advantage, tax-free, tax subsidized. And then we'll do a quick hit on plaintiff deductions, especially the deduction of legal fees, which has changed quite a bit in the last couple of years. So what are the high-level tax goals for plaintiffs? And there are quite a few. Number one is reducing risk of audit, right? Regardless of how they will report their income after this settlement, nobody wants to get audited. And if you are audited, guarantee you're going to lose quite a bit in expenses along the way, working with professionals who are helping you through the audit. And of course, chances are you'll end up paying more in tax because they'll take a more conservative position. You're not going to want to agree all the way, so you end up settling. Or if you fight all the way, then again, you have your expenses. Next is, how do you protect the plaintiff on audit? So if they do get audited, how can you make it so that audit goes really quickly, that the IRS agent actually just walks away because they see what they need to see? It's a bulk game, right? They're going around auditing a lot of different folks. And if it looks at first glance and at second glance that everything is either fine or not that far off, and if there are reasons for doing each of these things and good arguments, good positions, then that is going to be a great way to protect the client. You can do that at settlement. Third, of course, is minimizing their taxable income. Fourth is maximizing deductions. For every dollar that you get to deduct, you have the same effect as if you have avoided recognizing a dollar of income. Then there's deferring tax liability. Here we get into structured settlements and other options like that. And of course, leveraging tax preferred investing, whether you're structuring using an annuity product or a market-based product, both for legal fee structures, and I know that'll be discussed later today, but also for plaintiff structures, there is an actual subsidy in the tax code that encourages plaintiffs to wait to actually receive those proceeds. And if they do, then they don't get taxed, or they don't get taxed on the proceeds, or if they're tax-free, then when they get the proceeds, if they invest them, normally you'd be taxable. But by using a structured settlement and investing through the structure, you're actually getting to defer the time that you're taxed on the investment returns. And if the settlement is entirely tax-free, then the proceeds from the investments in a structured settlement will also be tax-free. And that is actually a tax, it's not a tax credit, it's a tax subsidy. The reason why Congress and the Treasury has protected that is because they have concerns about plaintiffs spending all of their money from a lump sum settlement and then requiring government assistance. So from their perspective, they want to encourage the investing through a structure, and of course it's of benefit to plaintiffs as well. So jumping into why and how settlement language can really help the plaintiff. So first of all, know that in almost every circumstance, when a taxpayer files their return, if there's ever a disagreement, the taxpayer, so here the plaintiff, bears the burden of proof. Now, you're all trial lawyers, you know the importance of that burden of proof and what it means, the value of actually shifting that to the other side. You can do that for your client by demonstrating, this is by statute, by demonstrating and memorializing credible evidence, and that's the standard, not a very high standard, credible evidence that the plaintiff is relying on in their tax position. You are, by statute, you are empowering your client so that down the road, if the IRS ever does challenge, the IRS bears that burden of proof. So you've already helped your client substantially. You've minimized risk. The next biggest risk is you want to prevent 1099s, right? At the moment that a defendant issues that 1099 reporting that your client is taxable on that portion or on the entirety of their settlement payment, the moment that happens, your plaintiff just jumped exponentially in risk because now the IRS believes that the settlement was taxable or a portion of it is taxable. And as we'll talk about next, the defendant's intention in making a payment is the main driver in the tax treatment to the plaintiff. So if the defendant is issuing a 1099 indicating that the defendant believes it's taxable, it's almost a game over for the plaintiff with respect to the portion of that settlement that has been reported. Now, of course, there are ways to argue around it. There are ways to challenge it, but no plaintiff wants to be in that position. And you can get into lots of discussions with the defense about their exposure and liability and penalties, and there are good answers to each of those. Feel free to reach out to me. I'm sure the folks Synergy will be able to speak to many of them, but there are good answers to them. And the number one thing you want to do is make sure that no 1099 will be issued, at least not for any portion that you believe is going to be tax-free, which is of course why you need to consider it before the settlement. In every settlement you want a clause that explicitly states that they will not issue a 1099, because if you don't do that, case law has repeatedly found that even if the defendant was wrong in issuing a 1099, you have no power to force them to rescind that 1099. So then moving to establishing intent. As I said, the driving factor, and this is what the IRS says, the Treasury and the courts have repeatedly concluded, that the key determining factor in the treatment of any particular dollar of damages is entirely based on the reason why it was paid. And that reason is in the mind of the defendant. The settlement agreement is your opportunity to memorialize what that intention was. They do not need to take a position regarding taxes. They don't have to say that this is an amount paid pursuant to section 104A2. That's something you might have seen, that it is for tax-free purposes. They don't need to take those positions. What you need to get them to say, and we'll talk about, you're probably aware that damages for a physical injury are generally tax-free. So your goal is to memorialize that all or a specific portion of the settlement was paid to compensate the client for their physical injuries or for emotional distress or things like that that are attributable to those physical injuries. Your goal is to memorialize the intent of the defendant regarding the facts that form the basis of your client's tax-free position. So then we get to allocations. Now here again, we're memorializing the defendant's intent, but we're getting more specific. So let's say there are 3 or 4 different potential reasons why your client might be receiving these proceeds. We all know punitive damages are taxable. So whether you're going to say that no portion was for punitive damages or just a small portion, you want to communicate that the 1/3 of it was to compensate for this physical injury. 1/3 of it is for the emotional distress resulting therefrom. 5% of it is for prejudgment interest, if that's relevant in your jurisdiction. The point is that you are establishing the intent and the amount of the damages that are compensating for specific reasons. And once you know what those reasons are that are going to result in tax-free damages, now you can maximize the portion of the settlement that is actually compensating for those types of damages. The IRS has taken the position and won when in cases where some of the settlement was going to be tax-free, some of it was going to be taxable, and there's no allocation. In that situation, the IRS has succeeded in taking the position that the entirety of the settlement is taxable. So it's really important to allocate. Okay, so next we're talking about protecting those allocations. So of course, the IRS could always take the position that the allocations you wrote are not real. They don't need to be respected. And there are a number of arguments they can make. It's not a very common argument for the IRS to make. Usually this happens when the plaintiff has unilaterally written the language and the defendant says, okay, fine, but we are not taking the position that this amount is for this injury. they're disavowing that language, or they're asking for an indemnification for tax purposes. The IRS has held, and the courts have followed, that when the defendant does that, they're not truly communicating their intent in the settlement agreement. And that's the reason why you want to push back on that language. There are many arguments you can make. It is not very burdensome to convince the defense that it will not harm them in any way, and that you can help them avoid any kind of exposure to liability. But it is important to get that language in to protect the client. And if for whatever reason you feel, given negotiations, given the timing, where things are, how the parties are acting, you decide you just can't do it, you want to have that conversation with the plaintiff. You want to have that conversation with the client. You want to memorialize to the client why you're not going to take some of those steps, because it does expose them. You're the one who is exposing them. So you want to make sure that they're comfortable. And it doesn't have to be a difficult conversation. You can say, hey, I'm no tax lawyer, but I'm aware that you may be able to get a better result for tax purposes if I do this. But to be honest, if I do that, I think we might lose this settlement. Now, I doubt, and in fact, I have never been involved in a settlement where we got to that point. But sometimes it can take a week of back and forth. Usually it's only a couple days, but it can take a little extra time, and maybe you don't have that time. So you can tell the client, it's in your best interest that we move forward, but you want to have that conversation. Okay, really quick kind of issue spotter on the buckets. So, if we identify a tax-free bucket, a reason why your client might get tax-free damages, and then we want to increase the allocation to that amount. So I mentioned damages for a physical injury and the emotional distress that comes after that. You want to increase, which is why we put it in green. The reason we put future medicals in red is because to the extent that you have allocated an amount to future medicals, when your client incurs and pays those medicals in the future, they can't deduct them. So we want to allocate down on future medicals. Same with interest, because it's taxable, and punitive damages because they're taxable. Now, in an emotional distress case where there is no physical injury, that's where you want to be finding signs of physical harm. Symptoms of emotional distress, which are subjective, damages for physical symptoms are going to be taxable. But the tax court has said that physical signs are tax-free because they are for physical sickness or a physical injury. This is where if you have any kind of objective evidence or even an allegation that the ailments that your client has suffered would be objectively verifiable by a doctor, well, then you are probably satisfying the threshold for the damages for that purpose to be tax-free. So, for example, your client might have been yelled at work repeatedly, and as a result, they ended up having a heart attack. That is probably something that a doctor would be able to verify. Or if there is some other kinds of impacts to their cardiovascular system. Again, we want to allocate down on interest and punitive damages. Then over to employment cases. Again, physical harms, physical injury, and the emotional distress that comes from them. Future medicals, and actually this is true for emotional distress. The reason I mentioned future medicals being a good thing here is if you don't have a physical injury, you can still, there's a very good argument that you can still take the position that the amount that your client receives to reimburse them for their future medical expenses, even if those expenses are to treat emotional distress. So if they're going to therapy, that could very well be tax-free. So you want to allocate up on that portion. On the employment side, the reason I mentioned legal fees here is because often we're dealing in wages. And to the extent that you allocate a portion of the settlement to legal fees, well, that is a portion that is not going to be treated as wages. So it's a great way to get away from, you're still taxable, but you now can avoid the employment tax side. That's again why interest and punitive damages I've identified here, normally you don't want those, but if we're trying to get away from wages, then that's a good reason to allocate for those purposes. Real quick on plaintiff deductions, we've already talked about medical expenses, but let's talk about legal fees. If the settlement is tax-free, you don't even need to worry about it because you don't need to deduct when you have no income anyway. But if the case is taxable, so punitive damages or interest in a physical injury case, emotional distress damages, or any other kind of taxable damages, there has been a change in the law as of a couple of years ago that you cannot deduct your legal fees in a personal injury case unless it's an employment case or a classic case of civil rights violations, so discrimination and so forth. Well, that can have a very significant negative effect. You end up, even though the plaintiff keeps only $6 of the $10 settlement and they pay $4 for the lawyer, well, now the client is still taxed on the $4 and then you're taxed on the $4, which is why many call it the plaintiff double tax. So let's say you had 40, your fee is 40%. Well, if your fees are 40% and they're paying tax at a 40% rate, 40% of 40% is 16%. Now they're essentially paying 56% to pay you and to pay the tax on your fees. And then after that, they still have 44% left and they're still going to be taxed on that portion. One solution, the only one I'm aware of, is one that I've worked on with Eastern Point Trust Company, which is the Plaintiff Recovery Trust. Here, claims are transferred and held by the trust. Money comes into the trust. Trust pays the fees, distributes the remainder to the plaintiff. And that's one way, and the only way I'm aware of, other than very, very aggressive ways that the IRS has said don't work. Only way I'm aware of to avoid that double tax in a case with taxable damages. So that's the quick 20 minutes. Again, I'm Jeremy Badner. I will be able to join the panel later today. So if you have any questions, please write them down and I'll be glad to field any of them. Of course, you can always contact me as well. All right, thank you very much.
Our next two presenters are Rasa Fumagalli and Evelyn Pacino. Rasa is an Illinois licensed attorney and the director of MSP Compliance Services for Synergy Settlement Services. Rasa and her team provide plaintiff attorneys with initial consultations to address any Medicare secondary payer compliance issues that may arise in connection with their clients' personal injury or workers' compensation cases. Evelyn Pacino is the executive director of Pool Trust Solutions. She's an attorney licensed in Florida and holds a JD with a concentration in elder law. Prior to becoming the executive director of Pool Trust Services, she spent 8 years in the Medicare Advantage industry. With that, I'll turn it over to Rasa and Evelyn.
Hello, and welcome to our webinar on public benefit preservation. My name is Evelyn Pacino, and I am joined here by Rasa Fumagalli, who is Synergy Settlement Services Director of MSP Compliance Services. She is an attorney licensed in Illinois and has tons of experience on all things MSP. And I am Evelyn Pacino. As I said, I am the Executive Director of Pool Trust Solutions, and I am an attorney who is based here in Florida. So first, I'm just going to get into a very quick public benefits overview. This is going to be very brief. This is something we could spend an entire day on if we wanted to. But just to give you really a quick overview of what kind of benefits are out there, what kind of benefits your clients might have, and some tips as far as how to try to figure out, what benefits they have so you can help them make good decisions. So the ones you really want to be concerned with are the needs-based benefits. So those are the benefits where those benefits are income and asset sensitive. And if the client was to receive that money outright into their bank account, it could potentially cause them to lose those benefits. So it would cause them to be over-resourced. So the most common ones you're going to see are supplemental security income, which is SSI, and Medicaid. So SSI is what's called a cash benefit, meaning the person gets a check every month. And Medicaid is a medical insurance benefit. And those two benefits are often tied together. So typically, and in a lot of states, not every state, but in a lot of states, once someone qualifies for SSI, they automatically qualify for Medicaid. So usually if they've got one, then they probably have the other. And then there are some other needs-based benefits like, a supplemental nutritional assistance program, which is food stamps formally. and Section 8 or housing benefits. So those are all the ones that if your client's getting them, you should be thinking about how to help them with their planning to make sure that they don't lose those benefits. And then there are also what are called entitlement benefits. So the entitlement benefits, generally you're going to see SSDI, someone who's on disability, or Medicare. And often those two are tied together as well, because one of the ways to qualify for Medicare is by being eligible for SSDI for 24 months. So if you've got somebody who's got Medicare, they may or may not have SSDI or had it in the past, and vice versa. So there are also some other Social Security benefits as well. Now, I will say a lot of clients don't know quite what they have. So you might ask them, what benefits do you have? And they'll say, I have disability or I have Social Security. And they may mean SSI, they may mean SSDI. So, when in doubt, ask them for their award letter. And their award letter, they may have lost it. And if they have, they can certainly go back and request a new copy from Social Security. They can actually do that online now through the Social Security Administration's website. And then that's going to tell you for sure what kind of benefit they do have. And then those same kind of award letters can also be requested from Medicaid or from those other programs that are administering these things. So, when in doubt, ask them for that extra information so that you can help make the right decision. Another thing to consider is that Medicaid does vary by state quite a bit, and there are multiple Medicaid programs within each state. So if someone just tells you they have Medicaid, that doesn't necessarily tell you what you need to know. Some Medicaid programs are income sensitive, some are asset sensitive, some are both, and some are neither. So it is really important to dig into that. You don't necessarily have to do that yourself. This is certainly something you can engage the services of a professional, such as a elder law or special needs law attorney, to really figure out exactly what benefits a person has, because it is going to be critical to understand that in order to help them understand what the impacts are of the money that they're getting, and then help them make some decisions about what to do. So when we're looking at needs-based benefits, the big question that we're going to get is it countable? So, if someone's got some plans about what they want to spend their money on, that's going to be the primary thing they need to look at. So just as some basic ground rules, generally you assume that everything is countable unless there's a rule that excludes it. And so the rules I'm talking about are Social Security's rules, Medicaid's rules. They all say, ultimately, what is an exempt asset, what is not an exempt asset. Another thing to keep in mind is that just because the money hasn't actually gone into the client's hands yet or into their bank account doesn't mean it's not countable. So funds can become countable when money is received, earmarked, or just set aside for them. So what that means is if there's money in the attorney trust account, it could potentially be countable. So typically, if the money has gone into the account and there are still liens being resolved and fees need to be paid and whatnot, typically at that point, it's usually not countable because the client doesn't have the right to 100% of that money yet. But once you get to that point where you could potentially give the clients a check for their net, just because you haven't actually cut that check yet doesn't mean it's not countable. It could be. Now, there's some practicalities around whether, Social Security would find out about that and how they would find out about it. And there's no exact guideline as far as, you've got 30 days or 60 days or anything like that. So this is something where you just want to move as quickly as you can, want to start doing that planning as early as possible, so that, the money is in that trust account for as little time as possible. Lastly, you're going to have to think about deeming. So what deeming means is that sometimes the money that one person has can be deemed to another person. So this happens between spouses and it happens from parents to children. So where we see this become an issue a lot of times is in minors cases where the parent or parents also have a consortium claim, but that parent is themselves not disabled, not on any kind of benefits, so they wouldn't qualify for planning tools like a special needs trust. The money that goes to that parent is going to be deemed to the child. So even if you take the child's money and you do all the planning necessary to protect their benefits, there is still a possibility that money going to the parent is going to count against them, is going to cause them to lose their benefits. So those can be very tricky situations. So you just need to be aware of that and be prepared to get the right professionals involved to help lead you through that. Some of the common exempt assets that we see and that are typically exempt by just about every program out there, one home, the residential home, and the items that go inside and around the home. Now, the exception to that is going to be things that are held more for value. So if you're talking about, if they want to buy bars of gold, right? That's going to be a countable resource. Now, if they've got gold jewelry, that is not a countable resource because that's something that they could wear and that's a personal item. So there are some intricacies there that you might have to worry about. And again, an elder law or special needs attorney or other professional is going to be able to help you figure out what's countable and what's not. A vehicle is also generally an exempt asset. So if you've got a client who's getting ready to get their money and they want to buy a house, want to buy a car, and they don't have those things already, then most likely those things are going to be exempt assets. And then some other things to consider, they're going to be countable resources just about every time. Any kind of cash they've got on hand, bank accounts, investments, money in the attorney trust account potentially, like I mentioned, and then anything that they give away. So just because your client is getting this money and they still want to qualify for their benefits and they think, oh, well, I'll just give this money to my son. I was going to give him an inheritance anyway. Unfortunately, Medicaid looks at that as a transfer for less than fair market value. And so that is not okay. That still is going to count as a resource for them. So just some important things to keep in mind. And then in terms of preservation, which is going to be, what we're trying to do here, the goal is going to be in all of these scenarios to turn a countable resource into an exempt resource. So there are a few different ways that you can do that. One, like I've talked about, is to spend the money. And again, it can be a lot of different things that are going to work for that, but you have to make sure that they're going to be an exempt resource, as considered by Social Security or by Medicaid or whoever is administering their benefits. Another option is to have the client create an ABLE account. So if you're not familiar with ABLE accounts, unfortunately, they don't work for a lot of people because they do have some restrictions that go along with them. But if you have a client who is disabled and was disabled prior to the age of turning 26, and they have less than $16,000 they need to protect for this year, then they might consider setting up an ABLE account. ABLE accounts are not counted by Social Security and Medicaid the same way that other bank accounts are. But the client is still in charge of that money. So they don't have to go through a trustee. They don't have to have an attorney set this up. This is something they can go online right now and set up as long as they otherwise qualify. So if it's a very small recovery, or, maybe most of the money is going to be spent, but there's just going to be a little bit that's left over, then an ABLE account is something to think about. And then the last option is a special needs trust, which I'm not going to spend a whole lot of time on here because we have a whole separate webinar specifically for that. But just the important thing to know here is that if you've got a client who's disabled, then they could set up a special needs trust. There's no limit on the amount of money that can go into a special needs trust, and that's going to help protect their benefits as well. So those are kind of the overarching things that you're going to want to think about. And I'm going to go ahead and turn it over to Rasa now to talk about the considerations when someone has Medicare.
Thank you very much, Evelyn. So it used to be that Medicare would pay for a lot of things that a Medicare beneficiary ever needed. And what happened though is that the Medicare Trust Fund started to deplete a little bit too quickly. So a law was passed called the Medicare Secondary Payer Act, and you can see that it is referenced on the slide, that basically makes Medicare a payer of last resort in certain situations. So Medicare is a secondary payer when payment has been made. And when I say payment has been made, you have to realize that a settlement is a payment that has been made or can reasonably be expected to be made. And it's important to see that this provision says under a workers' comp law, automobile liability insurance policy, or under no-fault insurance. So Medicare is a secondary payer act for settlements involving these 3 or 4 different categories. So Medicare did not want Medicare beneficiaries to go without medical treatment though. So they are willing to pay for injury-related treatment that is incurred prior to the settlement on the condition that the payment is reimbursed to Medicare at the time the case settles. So those are conditional payments. Next. And when we're talking about what is a primary payer's reimbursement obligation to Medicare? Medicare views a party as primarily responsible for care if there's a judgment, a payment conditioned upon the recipient's compromise, waiver, or release, regardless of whether or not there's a determination or acceptance of liability for items included in a claim against the primary payer or by other means. So you have to be careful when you're thinking about what is it that you're actually claiming in this case. You want to make sure that you don't throw everything under the kitchen sink into the settlement release, because Medicare may view itself as secondary for those conditions. Next. So as I mentioned, there's an obligation to reimburse Medicare for conditional payments that were made. If you do not do this, this reg here shows all the people that Medicare can seek to recover these payments from. You've got the primary payer, beneficiary, provider, supplier, physician, attorney, state agency, and private insurer. So it's really important that conditional payments are always addressed in connection with the settlement. Next. So what happens if you don't do this? If you do not do this, you can have, for conditional payments under Part A and Part B, you can have the Treasury come after you. There's also a private cause of action for double damages. It's really important to remember as well that Medicare Advantage plans, these are plans under Part C, Part D. They recover under the Medicare Secondary Payer Act as well. So they have the same rights of recovery in terms of double damages and the private cause of action. You do not get information about the amounts that have been paid by these Part C and Part D plans by reaching out to Medicare. You have to reach out to the recovery contractors that are doing the work for these Part C and Part D plans. Next. So because Medicare is a payer of last resort, they also take the position that if there is a settlement and there's a need for post-settlement injury-related care, that they should not be footing the bill for this treatment if the settlement funds future medical. So as an attorney or a person who is handling a claim, when a person comes in, you should first off identify, are they on Medicare? Are they going to be on Medicare? Is this injury one that's going to require ongoing lifetime injury related care? Or is it an orthopedic type of injury once healed is pretty much completed in terms of treatment? You should consider, is the settlement one that funds future medical? Or do you have policy limits and the past medical exceed the policy limits? And you should consider what the firm and the plaintiff's risk tolerance is. Next. Synergy has a Medicare expert case evaluation service, which helps parties, plaintiffs, and injury victims address these issues. So it's called a MSP, and we recommend that you start early when you're in the process of negotiating a case. We can either make a recommendation that the settlement is insufficient to fund future medical, therefore no MSA is appropriate. We might recommend an MSA, or the plaintiff might say, I understand the Medicare Secondary Payer Act is out there, but I don't want to do anything. And in that situation, we would get an MSA waiver. Next. So because I'm talking about Medicare set asides, it's important to recognize that there's nothing in any of these regs or laws that say what a Medicare set aside is. It's simply a settlement tool that allows parties to apportion some of the settlement proceeds for this future injury-related care. Before Medicare is billed for the injury-related care, the MSA funds have to be properly exhausted, so you have to administer them correctly. They can be funded with a lump sum or with a structure, and they can be housed in a special needs trust if a person is also on Medicaid. So if you do not want to set up a Medicare set aside, there are different ways to avoid cost shifting these injury-related expenses to Medicare. If you have non-Medicare insurance, that's perfectly appropriate. You can pay out of pocket as you go along. You can set up a Medicare savings account, settlement preservation trust, or you can purchase a structured settlement to account for this future medical care. Tips and techniques that of course spell out synergy. You can start by identifying your Medicare beneficiaries early on in the case. It's really important that you control the Medicare secondary payer process as opposed to waiting for the defense to present you with some unreasonable options at mediation or post-settlement. You should never rely on the opposing side's experts. Perhaps the opposing side's experts are correct, but more often than not, they are not, and they are looking to overfund. Since the potential risk of an issue with Medicare is going to fall on the client, the plaintiff, the injury victim, when it comes to post-settlement injury-related care, it's important that your clients are educated about the potential risks. We recommend that you retain your own MSP experts to help guide you and your clients. You should also be sure that you go on the offensive for any Part C liens and potential MSA issues. And it's extremely important that you document your file. Synergy has a wide variety of MSP compliance services that can help you with all of these different issues. We complete a Medicare verification. We would investigate whether there are conditional payments under traditional Medicare Part A and Part B. We also help address and resolve Medicare Advantage liens. As mentioned, we have the Medicare Expert Case Evaluation, MECE service. If a decision is made to proceed with the Medicare Set Aside allocation, that is something that we can help you with and do for you. If it's a situation where Medicare is willing to review an MSA in a particular settlement, we do also complete CMS reviews and submissions. We assist with Medicare set-aside funding through structures, and we can also coordinate administration of those Medicare set-aside funds. So if you have any MSP compliance services, we are here to help you. And it's important to think of MSP compliance issues in a holistic manner. Conditional payments, mandatory insured reporting agreements, as well as the need to avoid post-settlement injury-related care to Medicare. Thank you.
Presenters for our next segment is James Creel and Evelyn Piscino. James Creel is Senior Vice President of Business Development for Capital First. He joined Capital First in 2012 and has 30 years of experience in the financial service industry, including banks, investments, insurance, and trusts. He has assisted personal injury victims establish financial plans since 1989 and has helped over 1,000 personal injury victims establish plans to protect and secure their financial future. James is a chartered special needs consultant. As a trust consultant for Capital First, James works closely with settlement planners and trust attorneys to establish trust solutions to protect clients from wasteful dissipation of settlement funds and provide income, security, liquidity, and growth over the client's lifetime. In addition, he is being joined as a panelist with Evelyn Piscino. Evelyn was a previous presenter. She is the Executive Director of Pool Trust Solutions. She is an attorney licensed in Florida, holds a JD with a concentration in elder law. Prior to becoming Executive Director of Pool Trust Services, she spent 8 years in the Medicare Advantage industry. And with that, I'll turn it over to James and Evelyn.
Hello and welcome to our webinar about trusts and how they fit into a settlement plan. My name is Evelyn Piscino and I am the Executive Director of Pool Trust Solutions based here in Orlando, Florida. And I am also an attorney licensed in Florida. I am joined today by my colleague, James Creel. James is a senior trust consultant with Capital First Trust Company. He is a chartered special needs consultant and brings over 30 years of experience in the financial services industry, helping injury victims plan for their future. So today we are going to talk a little bit about various trust options that are available to injury victims. So I'm going to turn this over to James now to give you a more general overview of trusts and how they can benefit your client.
Great. Thank you, Evelyn. I'm James Creel with Capital First Trust Company. On the individual trust side, we use several trusts in personal injury cases, but the two primary trusts that we use overwhelmingly are a settlement preservation trust and a special needs trust. And I'd like to spend a little time talking about those two. A settlement preservation trust is just a management tool that we use as a way to preserve your client's settlement. So a personal injury victim won't blow through the money. It protects them from wasteful dissipation. And the trusts are designed both to protect the recovery and also to grow the assets and provide liquidity and growth for your clients. The trusts are typically established with part of the recovery from your personal injury lawsuit. It's designed, when you design a trust, you're designing it so that you'll meet their 4 basic financial needs, and more on that later. But we're trying to protect your clients from just blowing the money. That's the biggest thing. We all know it's the enemy that we face. They've been waiting for years to get their hands on this money. They've already spent it 12 different ways. And the challenge is, how do we use a financial tool like a trust as a way to stop them from wasting the funds and making funds available for them when they need them at times when they need that money the most. Often, settlement trust offers a custom money management portfolio. At Capital First Trust Company, we have a common trust fund where we have a diversified portfolio of stocks, bonds, and cash that's designed to achieve greater growth for their money. We have a tremendous track record on how we've invested clients' money, and over time, we've done a really good job, including some catastrophic downturns in the market. For the Settlement Preservation Trust, we have a sort of a 10-point thing of why you would want to use a Settlement Preservation Trust. Here's just some of the things it offers. First of all, it offers protection for your client. A trust document is really a legal document, and the trust will protect your client's settlement funds from creditors, judgment, garnishments, bankruptcy, and can even protect from divorce. The key there is the phrase discretion. The trustee has to have discretion on, do we make payments or not do we make payments? If the trust document says we will pay $3,000 a month and creditors can attach to that $3,000. But if it says we can pay $3,000 a month at our discretion, then they can't attach to it. The second thing is growth. We invest money so that it grows over time. We believe that the growth element is part of what augments your structured settlement offering. And we try to grow money in a responsible way that doesn't expose them to excessive amounts of risk. Part of the reason why we're growing money is point 3, we're trying to save money for later. Not every settlement is as much as the client would like. They have a lot of needs. A lot of times we need to put money aside, grow it for 10 or 20 years so that we can afford to pay for future needs down the road. And then finally, the 4th point, customization. Customization is probably the biggest key to a trust. A trust is probably the most customizable tool in the financial services industry. You can be customized any way you want to meet your client's needs. It's just a matter of sitting down with your client and say, what would you like to accomplish with these settlement proceeds? Or the money you're getting, what would you like for it to do for you? The number one thing they say is point number 5, they want us to pay their bills. We can automatically pay all the utility bills, pay for their electric bill, their gas bill, pay their rent or mortgage, pay property taxes, pay internet, cable, cell phone bills, pay those automatically so they don't ever have to worry about paying bills. They don't have to worry it'll be late or how that impacts or getting calls from people are having their electricity turned off, that kind of thing. Next slide, please. The nice thing about, we talked about sort of tailors into flexibility. The nice thing about the trust is it can pay for anything related to health, education, lifestyle maintenance. That even includes minors. A lot of times with minors, you guys put together plans to pay for college, which is really great and really important to have a guaranteed payment coming at 18, 19, 20, 21 to pay for college. But at the same time, where the trust can really help out is keeping children on track on education. So we can pay for tutoring. And quite often, it's just as important to keep them on track to get into college as it is to pay for college. After 18, courts will always require that we pay for health education, lifestyle maintenance, and support. Lifestyle maintenance is just setting up a budget. We can do legacy payments. We just did one for you guys where the beneficiary wants us to make the mortgage payments for his 3 children. So the trust is set up so every month we will pay the child's mortgage. So these 3 children get to live mortgage free for the next 20 years of their life. You can also do gifting. One of the most common things we get is people want to tithe to their church or give to a charity that they really believe in. And we always talk about, particularly in tithing to church, you give 10% of your income for a working person. If your only funds are in a trust, that's 10% of the growth inside the trust. And the last 2 points, expertise. We specialize in managing trusts for personal injury victims. It's what we do every day. We have 2,800 personal injury trusts, over 500 special needs trusts. And the last point is the trust will avoid probate. The trust can distribute the proceeds of your estate without opening time-consuming probate issues. And it'll pass, particularly if you have a will, it'll just pass straight through the will. The next trust that we offer is a special needs trust. And there's a lot of confusion about that, but a special needs trust is a trust that preserves the beneficiary's eligibility for needs-based government benefits such as Medicaid or SSI supplemental security income. People that are on these benefits, if they take their settlement in cash, they'll lose those government benefits. And a lot of time those benefits are every bit as important as the settlement amount. So it's a question of how do you maintain those benefits and allow the client to receive their settlement. There's strict rules regarding disbursements around a special needs trust. As a general rule, the trust will supplement the beneficiary's government benefits. We'll pay for what Medicaid won't pay for, but we can't replace that. And there are two main types of special needs trusts that we work with, first party and third party special needs trusts. Third party is pretty rare. Third party is like if you have a parent who wants to set aside money for their child or a grandparent that wants to set money aside for their grandchild. Typically, those are for children, grandchildren with special needs like autism, bipolar syndrome, that kind of thing. It's not a personal injury, wrongful death type settlement. First party special needs trusts are the type of trust you're going to work with most often, where the claimant gets a settlement and those settlement proceeds go into a special needs trust because it's their money. It's a first party special needs trust. There is a Medicaid payback provision on first party special needs trusts. But that only comes after their passing, and it only is up to the amount that Medicaid has already advanced for the client. It's a great tool for people that are on government benefits. A settlement fund, ideally in our mind, is suited for part or all of the funding of a trust, right? Typically, our view of the way we invest money is that we think you're going to do about half the settlement in a structured settlement annuity, and then half the settlement in another investment like a trust. So the annuity payments can be blended with the trust to create a better balanced portfolio. I call it a settlement portfolio that does a good job of meeting your client's needs. Every claimant has 4 basic financial needs. When I was with MassMutual, we did $1 million study to determine what the financial needs were for injured claimants. 4 basic financial needs that every claimant has are income, security, liquidity, and growth. Now, the structured settlement annuity does a great job for income and security. That's its primary purpose. And it has some limited liquidity. Trust can do income, but it's not the guaranteed income. It doesn't provide that security that your clients want and need with a structured settlement annuity. So when you think of blending a structure with a trust, your structure is primarily going to take care of the income and security needs of your clients. The trust should take care of the liquidity and growth needs of your clients. And if you position it that way, you can make a good case for why your clients need both products and how they work together and as part of your settlement plan. Periodic payments for a structured settlement can be paid into both a special needs trust and a settlement preservation trust. And once it's paid into the trust, it can't be encumbered or sold to a factoring company because the payments are assigned to us. The factoring company has to come to us to get permission from us to factor those payments. And it's just not something we're in the business of doing. Settlement preservation trust, you can take distributions, they can be adjusted depending on how your needs change. That's part of the customization of a trust that we talked about earlier. if you go through periods of unemployment or have unexpected financial needs, the thing I always talk about is if, the roof starts leaking or if the hot water heater goes out. That's an unplanned event. That with a settlement preservation trust, that is part of what we call lifestyle maintenance and support, that the trust can automatically provide the liquidity needed to take care of those unexpected events that come up in life. And again, in the funds inside the trust, the settlement proceeds are professionally managed by the corporate trustee. Securities are held in an insured custodial account. And when I say insured, I don't mean FDIC insurance. It's not that type of insurance. It's a separate account, separate from our assets of the trust. So if we have financial problems or any trustee has financial problems, it won't impact your client. And then we have large amounts of E&O insurance and fiduciary bonds that insure errors and omissions or bonds inside that account.
Okay, well, thank you so much, James, for giving us that overview of trusts.
Sure, my pleasure.
So thank you. So I'm going to go ahead and start on talking about pooled trusts. So I'm going to first talk a little bit about how they're kind of different from standalone trusts, which might be what everyone's more familiar with, and some of the misconceptions and things that might be floating out there that hopefully I can help you understand a little bit better. So in terms of a structure of a pool, and I'm not talking about a structured settlement, I'm talking about the structure of the trust itself. So a standalone trust is more of an individual trust that a person would create, for themselves, or a family member might create for another person. With a pooled trust, lots of people can join this trust. So it's an existing trust document. You join it by filling out what's called a joinder, which is like a contract, and all of the money is pooled together for investment purposes. So as we're going to talk a little bit more about in a minute, these types of trusts are better for smaller settlements typically, and this is one of the benefits of that. So with a pooled trust, all of the money is invested together, and then each person has their own sub-account within the trust, and the earnings are then shared across all of those accounts according to how much is in each person's account, basically how much they're contributing, they get a share of it. The trustee of a pooled trust is generally going to be a nonprofit organization, and this has to do with the federal law that authorizes special needs trusts. It's not necessarily a requirement for other types of pooled trusts, but usually the organizations that are administering these pooled trusts are nonprofits because they also have a special needs trust. In terms of how this is created, like I just talked about, it's an existing trust that you join by filling out a joinder agreement. The investments, however, are going to be a little bit different than a standalone trust. So typically a person can customize, they can work with their trustee to talk about, what kind of things they would like to invest in, and the trustee has discretion to decide what's appropriate. With a pool trust, because we've got so many people who belong to it and we need to take care of all of their interests and make sure that they're all provided for and make sure that the money is preserved long term, these trusts tend to be a little bit more conservative and the investments are very much diversified. So, we do our best to protect against, downturns and whatnot. So, every trustee is going to try to do. But, typically these pool trusts are even a little bit more conservative than the norm because we want to make sure that everyone who's a part of that trust is taken care of. So there are some different fee structures that exist within the world of pool trusts, can be a little bit different than how standalone trusts are done. Typically, they're going to have like an annual fee for trustee fees and investment management. There may also be a retention that is included as part of a pool trust, which is not something you're going to see on the standalone trust side. And so what that means is for a special needs trust, the federal law that authorizes them does allow the trustee to retain a portion of what is left in that trust when the person dies. And that is something that is done to help nonprofits keep the cost low, ultimately. So it's just something that, as you're shopping around for different trusts, you want to ask about the fee structure and ask about what their retention policy is so that you can be aware of it. And then lastly, these types of trusts are technically available in all 50 states, but there are some different rules state to state that are going to apply. And in some cases it may restrict the usage of them. So, it's again something that, you would have to look at in your state to determine what the rules are going to be. Most people, when they think of pooled trusts, they generally think of special needs trusts, and that certainly is the most common. And in our pooled trust, that's where we've got most of our beneficiaries. But there are some different kinds of special needs, or different kinds of pooled trusts, rather. So there are settlement preservation or settlement management trusts that do not provide the kind of protection for public benefits purposes that you would see on the special needs trust side, but can still provide a lot of protection for people who need that, depending on what their situation is. There are also some Medicare Set Aside pooled trusts that are out there now. And so these trusts exist to provide a professional administration option for people who need that. And for those who are dual eligible, it also allows them to take advantage of the protection of a special needs trust combined with professional administration. And then there are some others that I'm starting to see out there. So there's a military survivor benefit trust that does some different things kind of similar to a special needs trust, but more specific to military survivors and their families. And then some educational and medical specific trusts that are starting to arise as well. And so those trusts are, they can be similar to a settlement preservation trust, settlement management trust, but they might have some more restrictions that apply to them that are more in line with whatever the purpose of that trust is. So we are starting to see some more customization out there. So in terms of how a pooled trust can fit into a settlement plan, so James did a great job of summarizing a lot of the general ideas. I'm going to talk about more of pooled trust specifically, about how those might be a better fit. So like I mentioned earlier, they can be a lower cost option. They're also really quick to set up. So like I said, because the trust already exists, all the person generally has to do is just fill out that joinder agreement, which they could do in a day if they wanted to. With a traditional standalone trust, the person's going to have to go to an attorney to have that drafted. That can take a very long time, maybe very costly, maybe in the range of $5,000 to $10,000, which, again, with a smaller settlement, if someone's only getting $25,000 or $50,000, might not make sense to spend such a huge percentage of that on setting up this kind of trust. So pooled trusts are a really great option for people who have smaller settlements, but still have needs related to either just managing their money, or they're on public benefits and they need to have a special needs trust option, but don't necessarily want to go through having their own created. Another thing to think about, so I've talked a little bit about special needs trusts and how those preserve public benefits eligibility. But something a lot of people aren't aware of is that a standalone special needs trust is no longer available to someone once they turn 65. So in a lot of states, the only option for someone who's over 65 and needs to set up a special needs trust is going to be a pooled trust. Now there are some Medicaid restrictions that make that a little bit more complicated, so I can't make that as a total blanket statement. But if you do have a client over 65 who's on public benefits and they're trying to preserve those benefits, then looking at a pooled special needs trust is definitely something to consider. Pooled special needs trusts, because they are typically run by nonprofits that are usually providing other kinds of services in the community, provide a lot of additional services that very vulnerable clients might need. Clients who have maybe substance abuse issues or have had a brain injury, working with that organization can provide sort of a one-stop shop. So if your client's got needs, related to, housing issues and things like that, you might want to look for a special needs trust that's run by an organization who also provides those services. And there's a great diversity of those kinds of organizations that are out there. And then lastly, it can also be used as an alternative to a guardianship account and an alternative to a structured settlement, as James alluded to earlier. So it's just something to consider, if your client is in that situation where they might need to have a guardianship, maybe a trust is a good solution to be an alternative there. It's not going to work for every situation, but does work really well in cases of minors, because it gives the parents a little bit more access than they might have otherwise. Also, so when I'm doing consultations with clients, there are a lot of things that come up, that they might think about pooled trust, or they've heard about pooled trust, or maybe used to be true about pooled trust that aren't as true anymore. And so I wanted to just quickly go through like a few of those things to make sure, everybody understands kind of what the lay of the land as to pool trust is now. So there's, this idea that pool trusts are only going to distribute certain times in the month, maybe once or twice a month. That's probably still true of some trusts, but most of the ones I'm familiar with distribute on a much more frequent basis. Many will distribute on a daily basis, depending on the type of distribution that's being made. So there's definitely a lot more flexibility there. Some trusts do charge per disbursement. So again, that's something that you just want to look at the fee sheet for that pooled trust, is to find out, what are they charging me for? Is it kind of a, one-time fee that I'm going to get, or are they going to charge me every time I request a check or every time I request an upload to my debit card? There's a common misconception that the trustee will take all the money when the person dies. So as I talked about with the retention fee earlier, that is a possibility. The law does allow for a pool trust to retain up to 100% of what is left in that trust. That isn't as common anymore. Most trusts are more like in the 5 to 15% range. But again, that's a thing that, if you're helping your client shop around, you just want to make sure you ask about that, and then they can decide if it's acceptable or not. Some people think pool trusts are more inflexible, but again, this is just, it's going to be who you're working with, right? So some are very flexible, some are more rigid, and that's a question that you can ask them when you're setting things up. Now, this one is actually sort of true, but not 100% true. So, pool trusts generally do not own real estate or, non-traditional types of investments. But again, there are some trusts out there that will do that. So if that's a really important thing for your client, then that's, something you're going to want to look out for. And there's also been some criticism about the nonprofits that are out there operating pool trusts. Again, that's just something that you'd want to do research on. Who is this organization? What are they doing? How much experience do they have? How many clients do they already have? It's a good due diligence thing. And then lastly, sometimes people think that they are stuck with the pool trust that they have picked, and that's not true either. So it's actually pretty simple to do a trust-to-trust transfer. Those do happen from time to time. It's more complicated if the trust had to be approved by a court. But if someone is moving and their trust is not going to be available in their state anymore, then they might look for a local trust. Those things can happen. It's really not super complicated. And so then lastly, I'm just going to go over, just kind of a few things to think about as you're helping your client decide. And obviously this is not an exhaustive list, but just kind of some overall things. So the main thing is going to be, what are their post-settlement needs going to be? I mean, that's going to be the guiding light here. Do they need to buy a house? Do they need to buy a car? Do they have debt they need to pay off? Are they going to need support after? Is this a client that you're concerned that once they get their hands on this money, it's going to be gone? So, really that's the main thing, is what they're going to need. And then that can help you decide, is this better for a trust? Should we talk to an attorney about doing a spend down plan? And, you can kind of manage those options as they come up. Obviously, how much money the person is getting is going to be really important. If they're only getting $25,000, $50,000, then, maybe a spend down plan, maybe a pool trust, maybe a traditional special needs standalone trust. But again, you've got to look at, what the options are that are available. And then lastly, how capable is the client of managing their own money, right? So if you're going to do something, really expansive for them, are they going to be able to handle it? Particularly if you're looking at like ABLE accounts and those kinds of things, that gives full control to the client. And is that really in their best interest? And obviously it's their decision ultimately, but as the attorney, you can certainly help guide them a little bit down that path. So that is the end of my presentation here. So I hope that you learned something about trusts and how they fit into a settlement plan, and that we were able to provide some assistance here. So thank you. Have a great day.
Our next presenter is a nationally known and recognized tax attorney, Robert Wood. Robert is a tax lawyer listed among the top 10 tax lawyers in America. He consults on tax matters, writes tax opinions, serves as an expert witness, and handles tax audits and disputes. A widely published author known for explaining complex tax concepts. He is best known for advising on the tax treatment of lawsuits, settlements, and judgments. He is the author of Qualified Settlement Funds in Section 468B and Taxation of Damage Awards and Settlement Payments, both books I have on my bookshelf, and he writes a regular column in Forbes, Tax Notes, and other publications. With that, I'll turn it over to Robert.
Okay, how do you do, everybody? This is Rob Wood. I'm a tax lawyer with Wood LLP, and I get to talk about qualified settlement funds. It's kind of an evergreen topic. I suspect most of you, maybe all of you, don't need reminders about using qualified settlement funds. But that's mostly what it will be, a reminder, I think. In terms of resources, there is a big kind of cumbersome book that I did some years ago on qualified settlement funds. You can email me if you want information. There's also a BNA or Bloomberg now tax management portfolio on qualified settlement funds. Tax lawyers and big accounting firms have these things. There are hundreds of these portfolios. They're sort of done, and you can get them electronically now, but they were done in the old days as something to throw in your briefcase, hard copy, some decades ago, and they're still very popular. And there's one of those on qualified settlement funds that I also wrote, and you can buy those from Bloomberg just like per portfolio, I believe. There are lots of articles on QSFs on my firm's website, Wood LLP. And some of the links that you'll see, I guess they won't work for you as links, but you can get them off of my website. So qualified settlement funds, there's an intro of me. I think some of you know me. I'm a tax lawyer. I write a lot about these issues and advise a lot of litigants, mostly plaintiffs, but sometimes defendants. So qualified settlement funds are relatively simple. They, of course, came into the law in 1993. They were in the tax code before that is Section 468B was, but it talked about designated settlement funds, which are still around, but mostly not used anymore. QSFs were born of IRS regulations, Treasury regulations in 93. The government's talking about doing a revision to the regulations. I think everyone realizes that they need to, but that hasn't happened yet. So the QSF, most of you probably know, came into the law actually not to benefit. It's kind of curious, not to benefit plaintiffs and lawyers, but rather to benefit defendants. And it was because defendants in kind of big, messy cases, such as class actions, wanted to make sure that they got a tax deduction when they put money in, even though it might be years before money was paid out to claimants. And normally in sort of the tax rules on deductions and income, things are supposed to be reciprocal. And so you can view QSFs as a kind of a big exception to that rule. I say curious because now, I mean, most defendants, I think, these days are used to qualified settlement funds, but sometimes you still see, I expect you do, still see objections where defendants won't put money into a QSF, and sometimes need to be educated. So as you'll see on this slide, essentially one of the key rules is that there is this sort of deferral concept. It gets everyone time out of the presence of the defendant to decide how they want their money, when they want their money, and of course enables structures. This 10 Things article at the bottom from 2008 kind of lists some obvious points about why QSFs are good. You have a question, of course, about when you should do this. And there's no real right answer. Early is always better than late, like most things. But a common context would be when plaintiff and defendant are negotiating and they can't seem to resolve how the tax reporting is going to be done, how much accommodation the defendant is going to give the plaintiff. Sometimes it is because of withholding concerns. Sometimes a figure has been reached and no one's thinking about, let's say in a class action, and no one has amazingly thought about who's going to pay the employer side of the payroll tax. some of these kinds of contexts can be good for a qualified settlement fund. As many of you probably know, there are a number of kind of big distribution firms, class action distribution firms, mass tort distribution firms that handle administration of these things, and sometimes there's competition for that. But defendants, I think, increasingly hope to sort of get out of the thicket at the end of litigation, and that's certainly an ideal place for QSFs to come into play. Occasionally, I get asked to look at something where I can't really tell if the parties, including cases where there's a lot of money involved, I can't really tell if the parties really meant to do a QSF or not, or they probably did mean that, but nobody used the right words. So I just say, I mean, especially if there's any significant money involved, you don't want to be wrong. And so, try to urge someone, if it's not you, to get some professional advice before documents are signed. I note at the bottom single claimant issue, which never seems to go away. I'll come back to that. So the three requirements for a QSF are really rather simple, and this is in the regulations under 468B. First and foremost, it's got to be subject to court or government supervision. Classically, it's a court that takes jurisdiction over the QSF, and that is really this sort of government being in control element. In some ways, it's a legal fiction, because normally the government doesn't really do anything other than approve the existence of the QSF. But that's essentially the ticket to tax deferral. So it's really important, and it is acceptable to have, instead of a court, to have a government entity. So this is obviously much more common today. But in the old days, I've seen QSFs where no court was involved, but it was, a big agency like the EPA or a city government or something like that. And again, that should work as well. The QSF has to exist to resolve or satisfy legal claims. That's, again, usually pretty easy to satisfy. And third, it has to qualify as a trust under state law. Once in a while, I see these requirements debated. Probably the second requirement, I suppose, debated more than the other two. On the trust must satisfy. I've seen people, have QSFs with little or no documentation. I don't think you want to go down that road. I think it's sort of a pointless road, because it's easy to have what really amounts to a form document and then replicate it. And yes, I'm all for customizing things, and it really is to your benefit, for the client's benefit, really everyone's benefit, to specify as much as you can what's supposed to happen and the authority and this kind of thing. It is, I said, in most cases, the court or government authority really just approves the existence of the QSF, and then no one ever asks them for anything else. There are plenty of exceptions. There are cases that I've seen where the parties, for example, want the court to approve lots of things. So any distribution more than blank dollars or something like that needs to go and be the subject of a court order. And it's awfully comforting to have a pile of court orders that approve everything. But most people don't want to go through that hassle, and I don't blame them. I think on the backside of a QSF, that is when there's no money left, the tax code or the regulations actually say that's the end of a QSF. You don't have to have a dissolution document. When there's no money left, the QSF is deemed to cease existing. There should a final tax return that should be done, an IRS tax return 1120 SF. So kind of a weird tax return, but that should be done for any QSF. So you want to have an endpoint to this, and it's an orderly thing to have the court approve the sort of termination, even though it's not legally required. So trustee and approval. So trustee, I use the term kind of interchangeably, trustee or administrator. And sometimes you can have both. You can have a trustee that might be a figurehead person, and the administrator that actually does all the work, or the major part of the work. But I think you can use those terms, either a trustee or administrator. You need, and again, you can have both. It's surprisingly flexible who can be the trustee or administrator. As the slide says, anybody who has legal capacity, so can't be somebody who's a minor, for example. But it doesn't need to be a trust company, doesn't need to be a trust specialist. But I think that's a little dangerous because I mean, depending on the nature of the QSF in question, how long it's going to exist, who the claimants are out there, I just think being careful, you want to be careful. Accounting is really important. So I would say you don't, just be careful if you take on one of these roles that you know what you're doing. And I think just before I leave trustee, I think also the sort of the danger with the, how many hats you're wearing is also significant. I have seen plaintiffs' lawyers who prosecute a case for years. The money comes in and they say, oh, I want to structure my fees. And or they may say the client may want to structure, or we both may, we want some time, or whatever the sort of genesis of the QSF is. And they say, I'm going to put it in a QSF, or maybe you advise them to do that. But then the sort of end of my sentence. The lawyer himself says, well, I'm going to be the trustee of the QSF. So that sort of control is hard to relinquish, and it's not legally prohibited. I've seen it. I just think it's a bad idea. I think somebody else should be the trustee, and I think it can lead to, I guess being low-hanging fruit in the event that somebody wanted to attack it. So let's see. Tax treatment of QSFs. You got to get your own EIN, taxpayer ID number. That's pretty easy. QSF isn't taxed on contributions. So those are sort of like contributions to capital. Very frequently, a defendant will send a 1099 to the QSF saying, we just paid $5 million to the QSF. Most QSF administrators don't care. They explain that on the tax return that it's not income. So I would say if the defendant needs to do that to feel comfortable, that's actually not the same as the 468B statement they're supposed to do. But I've seen lots of 1099s in that context. The income, of course, is on earnings. So if the QSF earns interest income or dividends income, then it pays tax on that on its 1120 SF tax return. There is, and I think most people want QSF money invested conservatively. You don't want it in crypto, for example. So just be sensible to make sure that the money has been preserved. And deductions. The QSF can claim deductions for paying lawyers, paying accountants, paying the trustee or administrator. So very frequently, there's not a lot of income, except in really big QSFs that have hundreds of millions, billions sometimes of money, and even incremental interest can add up. So this page is sort of, I guess, whether this is about sort of see a lawyer page, I think. Retroactive QSFs, can you do one? The answer is under certain circumstances, yes. This article that was in Tax Notes some years ago, you could get on my website. It walks through what you need to do if you're in that position. It's not a position you want to be in. But it's a little bit of a Hail Mary pass. I mean, I've done them successfully, but I think it's once again something that you want to get some professional help on. And on this, what are the stakes? I think it's really asking yourself, well, wait a minute, what happens if it turns out that this QSF isn't a QSF, or if this account that it's in really is going to be treated like my lawyer trust account. In other words, if I, as the lawyer, let's say you're a lawyer, if I am treated as receiving this money, and bear in mind, that's a bit of a dual-pronged problem, because the lawyer in general is treated as the agent for the client. So the IRS and the states, I've seen this happen with the California Franchise Tax Board too, where if you have money that is, 60% the client's, 40% yours, even if the 60 hasn't gone out to the client, they will say that the client has income. So it's just think about what the consequences are. And of course, if it's defective, and I don't think I've ever seen this happen, but if you had structures in place, that becomes kind of a self-fulfilling prophecy, it must be a good structure. But could it be picked apart? I guess it depends on how how overtly defective the QSF was. Borrowing, boy, this is a hot topic. I can't give you a whole lot of information in the very limited time, but borrowing, I guess, forgetting about QSFs for a minute, is a loan income? It sounds like a stupid question. I mean, of course it isn't. If you borrow money, it isn't income. Why? Because you got to pay it back. You've signed a note, for example, saying I just borrowed $1 million and I'm promising to pay it back in a specified period of time with interest. But then when you start looking at and there are hundreds, thousands, I think, of tax cases about loans versus income, it's a super common thing for people to say, well, no, that wasn't income, that wire that showed up in my account, because I borrowed it. So it can be kind of a dangerous one. I think QSF borrowing, and when loan amounts paid out are viewed as distributions versus actual loans, is a confusing topic with a lot of variation. So I would just say there again, I think it's worth getting some advice. This article which you could get off my firm's website runs through some scenarios and proposes some sort of which ones might be okay and which ones probably aren't. So reporting and withholding, yeah, a big topic. I'm going to have to give it a short shrift here, but QSF steps into the shoes of the defendant. So it's essentially the same character of income: capital gain, ordinary income, Section 104, physical injury money, whatever it is. It's legal fees, same character when it is paid out from what is ostensibly this kind of middleman, the Qualified Settlement Fund. I've written lots of opinions to settlement funds on things like, you need to do a 1099 on this, or you need to withhold on this, or you don't need to withhold, or and not surprisingly, as with any tax opinion, it's typically not black and white. Most things are various shades of gray. So it's important to figure out what the facts are, what the objective is. Is the objective to support no 1099, or is the objective to support the reverse? It's a little like getting an appraisal of something. You want to know what you're trying to accomplish, and then you try to color within the lines. So wage and foreign person withholding, this comes up a surprising amount in legal settlements. The wage one more so, I guess, but foreign person, lots of settlements these days involve, foreign parties receiving money, and then you've got to look at those rules as well. Structured settlements, you all know a lot, probably more than I do, about structured settlements, simply payments over time, and their QSFs are really valuable for that. I would just say don't get sloppy, whether it's a structure for the client or a legal fee structure. Make sure that you check everything carefully. The form NASTA form documents are sort of the industry standard, I think, still, but just be careful. And sorry, the last point on the slide, if you're doing a legal fee structure, do a legal fee structure. Don't assume that the QSF is just going to sit there as a bank account. It's not efficient anyway, and it really is low-hanging fruit. I know some plaintiffs' lawyers that have done this, and it's really a bad idea. Time limits and duration, really amazingly, no time limit, but most people, I think many people in the industry say, as I do, look, try not to keep a QSF around longer than a year or so after all the controversy has ended. So if it's really clear and it's just sitting there and there is no dispute and everyone knows that it's all your money or all, three plaintiffs' money in equal portions, pay it out or set up a proper structure. Same thing for lawyers. So, I've seen class actions that exist for really a long period of time, many years, but that's not because people are sitting on their hands. Single claimants, I think this is a tempest in a teapot, and I don't think the IRS cares, but in this article from 2020, you could get on my website, might help you. It's got some, I guess, it tries to evaluate the issue. Of course, it doesn't mean everybody agrees. There are still people, AIG is, in my experience anyway, the sort of most famous one with the, anti-single claimant or anti-QSF for that matter, views. But it just, be aware of it. And I'm sure you're probably all adept at navigating that. Yeah, I guess, I didn't put this other link here. So legal fees, oh, okay. I was going to say, I wasn't sure what my point was here. I think the main point is that, in my view anyway, a QSF can help with the legal fee tax issues. Certainly optically, I think it helps. Depending on who the administrator is and what they decide to do, I think it can help on 1099 reporting. But fundamentally, I don't think that a QSF being interposed changes the bank's case, which is the third bullet down. The bank's case is, of course, the Supreme Court case from 2005 that basically said, as a general rule, when a contingent fee case is settled, the client gets 100% of the money for tax purposes and then pays the lawyer the contingent fee. And that's true, even though we all know that mechanically that almost never happens. The cash almost always goes to the lawyer's trust account where the fees are taken by the lawyer, and then the net amount, 60% in my example, goes to the client. So the clients usually think that the most they could ever be taxed on would be 60%. But of course, that's not true. Bank says the most you can be taxed on is 100%, and then you got to figure out how to deduct your legal fees. I would just say on this, there's almost always, in my view anyway, a solution. Legal fee deductions are, still, I didn't put slides on this, but there are lots of articles on legal fee deductions on our website, or if you can't find them, you can email me. I remember one is called something like 12 ways to deduct legal fees. You might look for that one. But there's usually a solution, but I think relying on the fact that you didn't have the gross income in the first place, meaning if I'm the client, I only got the 60%, that's the most I have to report. I just think it's a dangerous one from a return perspective, a statute of limitations perspective. So I would just be careful about thinking that, or selling the notion that a QSF, obviates the legal fee tax issues. Let's see. And I think that I am, I think I'm going to stop, and I believe there will be time for questions, and I will try to stick around for that when it happens. If for any reason you're not able to ask a question, or I'm not there to answer, or for any other reason you want to either email me or call me, my email address is on the screen. My phone number, that's my direct line, is on the screen. Please feel free to call and present your question, and I'll try to answer, or your case. And if I can help, I will let you know. Thank you all very much.
Up next to present on attorney fee deferral options are Anthony Prito and Leif Lundberg. Anthony F. Prito is a certified financial planner and one of the founding principals of Synergy Settlement Services. Mr. Prito has helped Synergy become one of the fastest growing companies in the United States. Synergy has been recognized by national, state, and local publications for its rapid growth. Anthony loves working with families and having a positive impact as they transition from litigation to life. He is a qualified expert regarding attorney fee deferral options as well. And presenting with him is Leif Lundberg. Leif grew up in Sweden, where he obtained a Bachelor of Law from Lund University, followed by a Master's of Law and Economics while attending Oxford. Following graduation, Leif worked in Stockholm for a few years as an analyst at a boutique investment banking firm and a law clerk at the Administrative Court of Nyköping. Hopefully I got that right. In 1997, he was offered an opportunity to join the international practice group of Smith, Helms, Mullins, and Moore. In 2000, Leif joined Op Capital as managing consultant advising corporate executives on the design and administration of non-qualified tax-deferred compensation. He has since consulted with both hedge fund managers and trial lawyers on the deferral of income and retention of key associates. Having had the benefit of working closely with trial lawyers and studying what others were doing in the attorney fee deferral market, Leif co-founded Jurisprudent Deferral Solutions in 2014 with the sole purpose of creating fee deferral solutions that give trial lawyers better quality, transparency, and benefit safety. As president, Leif is responsible for day-to-day operations of Jurisprudent and manages its sales and marketing efforts. With that, I will turn it over to Anthony and Leif.
Hi, my name is Anthony Prito. I'm one of the partners and owners at Synergy. I have been in the planning space for a little bit over 20 years now, and I'm going to talk to you guys a little bit about tax deferral on your fees. So over the last 20 plus years, attorneys that earn a contingency fee have been able to defer those fees with no taxes into a payout schedule that they design. It's a great benefit, and it's a little bit different than traditional retirement plans that most people have at their businesses. So there's no limit on the amount of funds that somebody can defer. You can defer from $1,000 to $100 million if you can find a place to put it. There's no age limit like typically there are on all of our retirement plans, where we cannot take funds out before 59 and a half without a penalty from the IRS. So you can defer as much as you want and take it out when you're 30, 35, 40 with no implications or additional tax implications. The range of payment schedules that you now can set up on the back end on how you receive the deferred fee are almost exclusive to whatever you can think of. You can design those payout schedules in a manner that fit your goals, and you can do almost anything that you can dream of in those. The amount of investment options has also drastically changed. It started originally with a straight fixed annuity, meaning you put your funds in, you knew the exact interest rate and the exact payout schedule you're getting. You could not make it quicker, you could not slow it down, you could not increase your return if the market went up, and you did not lose money when the market went down. You knew exactly what you were getting and on the day you were going to get it. There has been some changes, and one of those are some offshore assignment companies now that offer you the ability to do an equity index annuity, which is a little bit different in that it has a floor, meaning you cannot lose funds, but it does have some potential upside with the market. And we also have full equity-based solutions now where clients can put their money into things that are very similar to like a 401k or a retirement plan that you would traditionally have at any sort of company, with various EFTs and mutual fund options in there so that the client has full market-based risk. So I've got Leif Lundberg on with me, and I'm going to ask him a couple questions about their product. So Jurisprudent has always been an industry innovator. Their product is a little bit more progressive. So Leif, do you want to describe a little bit of how your product is different from the traditional fee structures that started the industry?
Sure. Thanks, Anthony, for the introduction. Yeah, so it's different in the terms of what kind of investments you can put in and invest in for your fee deferral. And so what we've created is a menu of low-cost index funds, Vanguard funds, iShare funds, covering most asset classes and styles, from which the attorney then can customize a portfolio. We also have 5 different model portfolios that they can choose from if they don't want to make the selections themselves. And it's an easy questionnaire that you fill out that would sort of generate a risk profile recommending which of these model portfolios might suit you best as the attorney. So that's one of the differences, is the ability to have the benefit of market returns over time, which is hard to beat over time. Now, if you're in a short-term period where you're just looking to defer for a couple of years, then it's better to be more conservative and put it, maybe leave it in money market. But the market over time, the equities, usually outperform. So that's one of the differences. The other one is really the payment structure. In a traditional attorney fee structure that's tied to the return of an annuity, you have a fixed payment schedule and you have to take it no matter what, regardless if you need it or not. In our program, we're following IRS regulation 49 Cap A, which allows for a redeferral of a scheduled payment, as long as that notice to redefer is submitted 12 months prior to the scheduled payment date. And if you redefer a payment, it has to go out a minimum of 5 years. So what most of our lawyer clients do, they actually set it up so that, let's say, payment starts in 2 years and then laddered over 20 quarterly payments, which is 5 years. And then they have an election, an evergreen election, to have those payments automatically redeferred. And that election can be turned off, or you look at it as a switch. You can turn that election off and say, I want to receive the next payment. So as long as you do that 12 months prior to the scheduled payment date, you're going to receive that next payment. Now you can turn it back on again and say, I'm going to redefer the next payment. So the payment is redeferred 5 years. So basically, if you have a 20 quarterly stream of income and you have that automatic redeferral election, your first payment, when it passes that 12-month deadline or notice prior to the scheduled payment date, that first payment is going to automatically roll to the end of the line of those payments. And they keep rolling, until you decide you want to stop the election to redefer and start receiving payments. So it allows an attorney to basically push payments out for as long as they want, or take it a lot sooner if they needed to. So it gives them a little more flexibility.
Okay, so one of the main, or the two of the main differences would be they'd have the ability to really choose different investments that are a little bit more aggressive than a fixed annuity, obviously. I assume that you got some low risk investments in there as well. And then there's the option to kind of continue deferring if they want to and manipulate the payment schedule, well in advance. So it's not perfect. They can't do it the day before, but they'd have the ability to defer, 13 months or 12 months out before a payment comes in, redefer.
That's correct. And yes, I mean, to answer your first question is, we do have more conservative investment options, fixed income. There's a bond fund, there's a treasury fund, there's, so if attorneys are nervous about the market or just want to allocate a portion of their fee deferrals into more conservative investments, they can do that. And they can also use, they don't have to invest everything at the same time. They can choose to use dollar cost averaging into investments, over time, which sort of reduces the volatility risk of timing the market.
For us, it's traditionally been the toughest decision for an attorney to make is that first deferral. And then once they do make the deferral into one of the plans, regardless of which plan it is, they typically will either defer into another type of plan or defer into a similar plan, but they become more consistent in the deferrals because they realize how easy it is and what a good benefit is to them. But traditionally for us, we need to be involved with the trial lawyer well in advance so that they can do some personal planning on and not really case specific planning. So is that kind of similar to what you're seeing in the market?
Yeah, I mean, most of our clients, they defer more than once, right? So once they have the plan set up and they, see how easy it is and how transparent it is, because they can view, you can view your investment performance 24/7. You can look at your payment schedules, when the deadline is to redefer or withdraw a payment, and so on. It's got the same look and feel as if you were in a 401k or an IRA plan, right? The benefit is the compounding of these investments. The growth, any dividends, interest you receive is all reinvested in the plan, so it grows at the same speed as a 401k.
Would be, well, what happens if something happens to me? So if I do all the appropriate planning and I come to you guys and say, okay, on my next fee, I want to defer it. I get all my paperwork squared away and I defer. And obviously we're all involved in the personal injury space. So we know that accidents happen and something happens to me. Do I name a beneficiary on my account? What happens to that asset? And how does it get transferred to my beneficiaries?
So just like any benefit plan, you can designate a beneficiary. It could be a trust. It could be, your spouse, your kids. So it's pretty straightforward. If you were to pass, it will go to your designated beneficiary. If you don't have a designated beneficiary, it will go to your estate by default.
Okay. So it's similar to like the annuity contracts. You can name a beneficiary and change a beneficiary.
Correct.
A little bit about the cost structure associated with your program.
Sure. So our standard fee is 1% annually on the deferral balance. Depending on the size of the fee deferral, there are some discounted fee. If it's above 5 million, above 10 million, the fee is further discounted. So, but the standard fee is 1%.
Okay. In terms of your overall group, how many firms would you say, or what a round number on how many firms are actually using the program now with you guys nationally?
Last time I checked, we had about 231 law firms, and we're sort of adding every week, more law firms as clients. And most of our clients are repeat customers, so they defer once and then just keep deferring. I think the percentage is like 75%. And I like to believe that the other 25% just waiting for the next settlement so they can defer again. In a lot of those cases, that's probably true. And some that, someone may be close to retirement, they just defer once and then they're retired, so they're not going to practice anymore. But those are pretty rare.
I think that's similar. So we'll see some attorneys that hit a home run and want to defer that fee specifically, because it's not a normal part of their practice where it's a larger fee. And then I've seen the opposite where we have people that, defer a little bit of almost every fee, so it's, it cumulatively adds up to a large deferral throughout the calendar year. You have some good examples of really successful ways to do this, or firms that are doing it in a way that, maybe helps with retention of key employees, or it just helps with cash flow at the law firm, just kind of alternative ways than other than just saying, hey, I'm going to defer this fee for my personal, retirement. Is there any other progressive ways that you see attorneys taking advantage of this out there in this market space?
Yeah, so I mean, there are a lot of applications for the deferred fee. The most common, obviously, is to avoid the immediate taxation and then defer the tax and spread it out over several years. Leave it for retirement and just let it grow and compound over time. But there are other applications, and we have some attorneys that use part of their fee deferral. So they basically schedule one quarterly payment each year and they give it to charities. And so that's one aspect of it. The other aspect or another aspect is retention of key employees or key associates that you mentioned. Because the law firm, or the lawyer, when they defer, if they're the principal of the firm, they can use this deferred fee, just future income, to fund a deferred bonus plan for key associates and set up like a vesting schedule. So, it could be you award an associate $100,000 in a deferred bonus, then you set up a vesting schedule over 5 years. So the associate, has to work for you for 5 years to receive that benefit. Another way to do it, I mean, there are all kinds of different vesting schedules. It's really depends on what the needs are for that particular firm. But if you keep doing it every year, you basically complement a cash bonus with a deferred bonus. You're creating this retention or golden handcuff.
I wanted to ask a little bit more specific to the actual documentation that goes on in here, because I know I've called you on cases like this, and attorneys call us on this a lot. Hey, Anthony, I just settled a case. I've got $1 million in my trust account. Can I defer that? And the answer to that is an obvious no. With a traditional fee structure, there's a lot of documentation that goes into the release, the settlement agreement. The check typically comes from the carrier directly to the insurance company they're deferring. How's the documentation, the paperwork done with jurisprudence that differentiates it from a traditional annuity deferral?
So the tax basis is the same. I mean, the attorney needs to make an irrevocable election to defer the fee income prior to constructive receipt. And normally constructive receipt would occur when the settlement is done, the release has been signed. There's no more work to be done, right? You're just waiting for the check to be paid. Then you're likely in constructive receipt of that fee. So they would have to enter into a deferral contract prior to the release being signed in the case. And what we also like to see is that they have some sort of language in their fee agreement with a client that allows for them to defer or structure their fee, because the client is ultimately the obligor of the fee. It's not the defendant or insurance carrier.
As a CFP, one of the things that I always like to encourage, the audience that we have here would be, if you're going to do this, it is to take some, preventative action right now. If you think you want to defer a fee and you don't know what case it's on, you should actively start looking at it now, because you can get information on all the types of products that are out there. You can decide what's appropriate, and you can be have tentatively made a decision on what you want to do before you actually settle a case or even have the case in-house that you're going to do it on. I think that's been the hardest thing for us. And I'm going to ask you the same thing. We get a call so late in the case and the attorney has been so, I don't know what the term would be, but they're so invested in the actual case, they're not thinking about anything on the fee. They're thinking about, how can I help this injury, this victim or this family get what they deserve? And then, you finally get to the finish line and you realize, hey, this is going to have a huge implication on me personally with the tax that are due. What can I do? And at that time, it's really hard to make that decision because you haven't thought about it. So that's been one of the hurdles that we've had to overcome, is getting involved quicker, because it is a hard decision to defer your money, right? Like I'm sure you and I would have the same issue. If we said, hey, this case is mediating tomorrow, you need to make a decision on, no matter, you don't know what you're going to get, but let's make a decision on, do you want to defer this or not, and get the paper, get it docked before you go in there. So that's been one of the hurdles, is just how do we get involved sooner and get people thinking about it a little bit more on the front end. You have any advice for us there?
As long as you make that decision before the release is signed. I mean, you have the mediation, and then, it usually you have some time in between before everything's signed off on, right?
And I know you're going to stay on with us for the Q&A at the end of the webinar. So if anyone out there has got specific questions on this, feel free to submit them, and we're going to answer all those at the end. But kind of just in closing, I mean, you guys have got a really unique opportunity here. Like Leif mentioned, you're one of the only groups that can do this because it's contingency fee based. There's really no limitations other than the creativity of you and your planner or Leif's team on what you can do with the money if you go that route. Even on the fixed annuity side, you can set up almost any payment schedule that you can imagine. There's no age limits to defer in terms of your age being as old as you want or as young as you want on the withdrawal. And there's so many different products that you can put the funds in on the back end. You really have an unlimited choice, based on your current risk tolerance. So the program is really out there for you guys to take advantage of and design it whatever way you see fit. And the fact that there's very low minimums on any of the products, it's something that you probably should dip your toe in and get comfortable with. And like Leif said, and Synergy's experience is the same. Once you do it one time, it becomes a more consistent part of your practice. And you'll be amazed at how much you can defer and the kind of income you can create for yourself just by doing this consistently.
My name's Jason Lazarus, and I was your first presenter of the day, and I'm going to be your last. So batting cleanup today. The last presentation is going to build on all the things that have already been discussed and explain to you how to leverage Synergy's services to make sure that you address the case after the case, all these issues that all the other speakers have so expertly talked with you guys about today. So what it really boils down to in the settlement planning context is making sure the client is protected and their recovery is protected. And the starting point for that is typically an analysis of government benefits, looking at what they receive, determining what needs to be done. So if they're on SSI and Medicaid, looking at special needs trusts and alternatives to make sure that they continue to receive their government benefits that are needs-based. If they're a Medicare beneficiary, then looking at Medicare Set Asides and what needs to be done from a planning perspective to make sure those government benefits are protected. And that's part of our overall settlement consulting services. So looking at all the issues that are presented in that particular case and developing a plan to address protecting that client's recovery and protecting them for the long term. And some of that might involve our structured settlement services, which allows you to have an expert in what is a very complicated financial transaction and very important financial transaction for the rest of that disabled person's life. And then also looking at trusts, because trusts are usually part of a settlement plan, and there's some really important things to consider to determine what is the best solution for that injury victim. So looking at all of these issues together is what our settlement planning consulting team can do for you and your client, bringing an expert to the table that can help you navigate all of these issues. But I wanted to take an opportunity to talk about all of Synergy's services because they all are synergistic, hence Synergy's name. So from Medicare secondary payer compliance, making sure that your file is closed compliantly if you're dealing with a Medicare beneficiary, to making sure that there's an analysis of government benefits that are done that helps them preserve their needs-based government benefits or Medicare, settlement planning and consulting, which we've talked a lot about today, cases where you've got complicated liens, whether it's Medicaid, Medicare, ERISA, FEBA, military, hospitals, those types of issues can be addressed simultaneously to all of these issues by our lien resolution team. looking at attorney fee deferral options, which was touched upon today. And then if you have cases that involve multiple claimants, we can handle those through our group projects unit. But everything we do is focused on allowing you to focus on what you do best, which is help the next client. Let us tackle the case after the case. And I always end our presentations with something about our team, because I'm very proud of the team we've built. It's a mission-based team. We count our successes by how many families we've helped and how many lives we've positively improved and touched. And this team that's in this picture is dedicated to that mission and purpose. It's what we do every day, get up and fight for the injury victim and fight as hard as we possibly can to protect that settlement, to make sure lien holders are paid as little as they can possibly be paid and maximizing that recovery while protecting that injury victim. And we've been recognized as one of the fastest growing companies consecutively by Inc. magazine, because I think law firms understand and align with our mission, which is really in lockstep with what you do every day to protect injury victims. If you have any questions about any of the presentations today or about any of the things that I've talked about, please don't hesitate to reach out to me. You've got my email here, you've got my phone number. I do a lot of consulting all over the country with trial lawyers to make sure that all of these issues are addressed holistically, and our team is dedicated to that as well. So thank you for joining us for today's Settlement Planning Summit.